Welcome to the Credit Clubhouse, where we take a weekly dive into the world of credit markets, alternative finance, and everything in between. Don't forget to follow the show, rate us, write a review, and share with friends. We're always open to guest or show ideas, so please feel free to reach out anytime. Just todd.anderson@dealcatalyst.io. I encourage you to check out the remainder of Deal Catalyst's 2026 calendar, including ABF 2026, Fund Finance West moving to Vegas for the first time, and GPLP Secondaries, which is a new addition to the schedule. Listeners can get up to 10% off any ticket to any conference by using the promo code CREDIT at checkout. And now, on to our next episode. This episode is brought to you by Cardo AI, the operating system for asset-based finance and private credit. These markets still run on spreadsheets and siloed systems. Cardo AI brings everything into one system: the data, the structuring, the borrowing bases and waterfalls, the cash flow modeling and simulations, and the investor reporting. That's front office to back office, all in one place. Today, more than 700 facilities and $150 billion run on Cardo AI. The world's most sophisticated investors and lenders use Cardo AI, equipping their teams with a level of control and intelligence that legacy tools simply cannot match. See it for yourself. Talk to the experts at cardoai.com. Welcome back to the latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, head of content and programming at Deal Catalyst. Joining me today are Kelly Thompson, managing director, and Eric Rosenthal, head of default research. Both are with KBRA DLD. Kelly, Eric, thank you very much for the time. Looking forward to our conversation.
Thank you for having us.
Thanks.
Of course. So if we think about kind of setting the stage, obviously there's been a wave of headlines about, seemingly the cracks in private credit. But, from your perspective, how much of that narrative is actually supported by, direct lending data?
I would say very little. And Eric, I think you'd agree with me.
Definitely. Yes, I would.
I think, individual large deals easily call attention to, mainstream headlines. And, therefore everybody thinks, okay, the whole entire market is a problem. And it isn't. Those are like very specific, large deals that grab headlines. In reality, the direct lending market is actually mostly small and middle market borrowers. And our estimate is probably around 75% of the market is made up of small and mid-sized companies that you've never heard of and will never be big enough to make a headline on Bloomberg or the Wall Street Journal or whatever. So the way we look at weakness in the market, we use 4 metrics, and right now they're all showing a very, I would say, modest default environment. The first one, we look at the trailing 12-month default rate. Right now, that's 1.5% by volume of the KBRA Direct Lending Index, which is about 300 billion right now and about 3,000 borrowers. I would say 1.5% is hardly alarming. It's not, I don't think that signals that the private credit bubble is about to burst. The second metric we look at is non-accruals. By volume, the rate right now is about 2.4% of our loans in the index. We separate non-accruals from defaults because non-accruals signal stress. They don't necessarily signal a default. Managers put something on non-accrual for a wide range of reasons, not necessarily for non-payment, although a lot of the times they do that, but that's not the only thing. some investors out there would combine the default rate and the non-accrual rate, and that puts you at roughly 4%. Again, that's still in line with historical average of 3 to 5%. Third, we look at, we have a watch list that we call default radar. About 5.8% of volume on the index is on that watch list. Again, not a big scary number. That has continued to tick up, though, I will note. So it is something that we're monitoring. But again, it's not at a level where that's concerning. I think that's, it's an acceptable level. It's a modest level. It's not something horrific or to be alarmed about. The fourth metric we look at is also PIC, which is a big topic of conversation in mainstream headlines. We have about 3,000 borrowers in the index. Of those, about 375, or roughly 12.7%, have a PIC element, which means they could be picking 1%, they could be picking 5%, they could be picking 10%. For us, the most concerning group to look at within that smaller data set would be those picking more than 3% interest, because for us, that signals that's less of a we're opting to pick and more of a we need to pick type of situation. And within this group of 375, about 240 are picking more than 3% of interest. So that's another thing that we keep an eye on. But again, it's still a very small subset of the index. And I will say, anyone interested in learning more about, our methodologies and the fine print and all that, please reach out directly. We're happy to share all of that.
I referenced it at the top, obviously, when I said private credit, but it feels like that terminology is kind of losing a bit of clarity around it, considering how much is, I think, under the umbrella of private credit today. But from your vantage point, when people do say private credit, are they lumping like incorrect stuff together? Should the market kind of have a terminology reset in some ways?
Absolutely. I think that's one of the big problems right now facing the market, because you hear private credit and everything gets lumped into that, right? But it's really more about the distribution strategy than it is about the asset. A leverage loan is a leverage loan, whether it's broadly syndicated or book to hold, which is the main difference between what you see in BSL and what is called private credit, or what we cover, which is direct lending. It's basically club versus syndicated. They pitch the same loans. JP Morgan will pitch the same issuer on the same financing amount as will Blue Owl or Ares Capital. It's just a matter of how are they going to distribute that loan? And that also, reflects how some of the terms on that deal will shake out. But at the end of the day, it is the same type of asset. It's not, asset-based lending, another totally different category that can also fall under private credit, depending on who's underwriting it. But it's not new. It really should describe the distribution strategy, but unfortunately, private credit has become, all encompassing of all these different strategies. And I think that really gets the market in trouble because it's not really distinguished in the media. And then regulators see that. And then they think, okay, private credit's blowing up. Well, it's not private credit blowing up. It's, that was a factor finance deal that blew up. That was an asset-based lending deal that blew up. Very different. So yeah, I would say, the private credit overall branding is definitely an issue.
Obviously, there is still that narrative still exists about the systemic risk. And there's clearly we just talked about the disconnect between the public narrative and what the performance data says. Kind of from your seat, is there, kind of where are the biggest risks, today, and what is the data telling you about, kind of whether or not the market's overstating some of this default risk in direct lending, at least at the moment?
I would say, in terms of systemic risk, we don't have specific data that will show a systemic risk of how private credit fits into the bigger picture. But what I will say around that is, the reason why in the post-credit crisis era of, 08, 09, 2010, there were regulations that were rewritten, and that occurred because the government wanted to move risk out of banks. Banks play with depositor money, so let's move out this risk from this system. Retail money, what is that? That's my money. That's your money. That's mom and pop money.
Yeah.
And that's exactly what's happened. A lot of leverage lending has now moved outside of banks to lenders that play with mostly institutional money. Retail, they are starting to creep into retail. But largely it's an institutional market. And the benefit of that is that institutional investors are sophisticated investors, and they will drill down into lender profiles and performance, et cetera. So I would say that the system was revamped to move this asset, or to move this market into, out of banks. And that's exactly what's happened.
What are some of the, obviously private credit gives off the feeling as if it's obviously different than public markets. When it comes to transparency, what are some of the misconceptions around how transparent private markets are? And is some of that starting to change in terms of transparency?
Sure. I really like this topic because it came up recently on a panel that I was on, and it was really interesting. I think I would say, I think the problem that private credit has right now is less about transparency and more about standardization of data that's available. Good managers disclose their portfolio performance, warts and all, to their investors. And they do that on a regular basis, and you have to, otherwise they're not going to invest with you. So, the idea of disclosures and, the market not being very transparent, I don't really know that that's the issue. I think it's more of, there's no one provider of data that, does everything. So you have to go to different providers for different bits of data. And then in some cases where there are multiple providers that do offer default rates, we all have our different methodologies. So, a manager might use our default rate to make their point on something, and, another might use a different agency, or an investor might say, well, what about this rate? This is different at this agency. Why is that? So I can understand why there's confusion around, transparency in private credit. But really, I think, and I've heard this from the market too, it's more about standardization. There's really, and it's hard to do that in private credit. I don't know that standardization is really achievable at this point. And that's because there's no universally accepted definition of private credit, right? Like, as we kind of talked earlier, it's different things to different people. And even within direct lending, there are a variety of strategies: lower middle market, upper middle market, distressed real estate, infrastructure, whatever. So that's hard to standardize. And then, there's just different methodologies depending on who you talk to. There isn't really one way of looking at this. And I think that's what makes it difficult for investors and for managers to educate investors in this
Are
market.
people underestimating the role that sponsors and lenders play in stabilizing stressed borrowers in direct lending compared to the broadly syndicated market?
Eric, why don't you take this one?
Yeah, I think they are underestimating it to an extent. I think there's a much more collaborative effort in direct lending than people maybe realize. It's part of the reason why defaults, take time to actually materialize in direct lending. We have our default radar, which again is kind of monitoring, the most worrisome credits in the market. We have kind of our red tier and our orange tier. And some of the names on the red tier, which are the more worrisome ones, have been there for 2+ years so far. Now, they're not improving per se, but they also haven't defaulted yet. And if I compare that to, say, broadly syndicated loans, if you had a name on our red list there, very good chance, within 6 months, you've probably restructured or filed for bankruptcy or done some kind of default action. So I think that plays a big role.
And I think, and also, the reason for that is, in BSL, you have a lot of different types of investors in those deals and coming in through various structures. And so their agendas are very different. And, they often butt heads as to, how they want to work out the loan or how they want to move forward. You have hedge funds, you have crossover accounts, you have several different types of investors with different outcome goals in mind. Whereas, in private credit, these loans are not widely distributed. Oftentimes there's one lender in the deal, or maybe, if a deal is $1 billion or bigger, that also could be one lender. Maybe it's 2 or 3 now, because I do think hold levels have come down. But again, if you're the sponsor, you have that direct relationship with whoever is holding your loan, and it's much more of a collaborative process than if you have, say, 100 accounts.
Right. Plus the quarterly mark-to-marketing plays a role too, versus the daily, BSL high yield marking that you see, which could kind of almost force a default type of action.
I think COVID really highlighted the relationship factor for sponsors, and how important that actually was. When nobody knew what was going to happen in such an unprecedented event. I think that actually was a boon for private credit.
Do you think lenders today, after, say, the last 18, 24 months, they're becoming a bit more disciplined on leverage, documentation, sector selection?
I would say yes. I do think some of our research shows, depending on where you're playing, we cut data by EBITDA. So there's lower middle market, upper middle, large cap. And
just for the audience's purposes, what are the ranges there in terms of how you guys define it?
Sure. So for us, lower middle market is less than 20 million of EBITDA. Then it goes 25 to 35, above 35, 50, above 50 to 75 or 100. I should know this, but 100, over 100 is large cap. So the levels within those groups are different, obviously, but there has been a downward trend over the last year, I would say. So it has been tightening pretty much, I would say, across the board over the last 12 months. Pricing has also reversed course. It had been going lower, but now spreads, I'd say, are about 25 basis points, maybe 50 basis points higher than they were at the start of the year. Even though syndicated loans have tightened, normally you would see a tightening then in private credit. But I think what's happened is redemptions have played a part in pricing. I think managers now have to deal with, okay, we might actually have a 5% redemption cap coming. So, maybe we're going to take a harder look, or we're going to do less money on this deal than maybe we might have done last year or 6 months ago. Instead of underwriting a $750 million ticket, maybe we'll only do 400. And also because we're being more conservative with our allocations, that's also going to affect pricing. They're going to want to price up actually a little bit to do those deals.
One of the obviously big areas that has come under greater scrutiny is the software. SaaSpocalypse is a term that's been used.
Yep.
Not exactly the best terminology in my opinion, but there's certainly been a lot of concern around software exposure in portfolios. How much of that, fear is actually warranted, and has that also become kind of overgeneralized and sensationalized a bit?
Yeah, I mean, I'll take this one. So I think it's fair to at least have a discussion about software, but at the end of the day, I think it's really overgeneralized. And I'll go right to the default rates for our forecast for 2026. So for software, we're looking at a 2.5% default rate. That's the same as the overall default rate, 2.5%. So yes, and right now, for what it's worth, the trailing 12-month software default rate's just at 0.4%. Now that's going to move up. Medallia is the big driver for this year. When the restructuring closes, it's in the midst of going through right now. That'll drive it to nearly the 2.5%. We've got a few more software companies that we expect that will default in 2026. But overall, there are a couple other more sectors that I'll be more worried about than software, honestly, at the end of the day.
What are some of those that, to kind of, follow up on that point? Where is the stress in the market?
Yeah, sure. I'd say probably consumer would be the number one, and also healthcare to an extent. In terms of where the defaults are going to come from, those two sectors, consumer and healthcare, probably going to account for about 40% of the defaults that we see for this upcoming year. So that's definitely one of the drivers. But the good news is, in terms of the default rate, both not so bad even. Consumer looking at about a 3% default rate. And the reason for that is so low is because the consumer defaults that are going to happen are going to be relatively small sized. Kelly touched upon that earlier, how a lot of these
Yeah.
companies are small, mid-sized. That's kind of what we're seeing. Healthcare, there are a couple of big ones out there that are going to drive it. We're looking at about a 3.5% default rate for this year.
So if I guess a follow-up to that, if default rates are showing and the data is showing that, then why is everyone's hair on fire about software? Is it just because of the unknown around AI and what the potential impact could be, even if today the data and the numbers are not necessarily reflecting that impact?
I mean, I think that's fair. And you did see, in the first quarter, we saw fair value marks for software. Almost 60% of the names dropped versus the prior
Yeah.
quarter. So the marks are going down. So there's definitely some worry behind it, which is why I mentioned in the very beginning that it's worthy to have this conversation. But in terms of actually defaulting, that's a whole different picture. We're not at that level yet. Could there be a spike in 2027 or 2028? Yes, that is possible. But also important to remember is how big this universe is. Software is about 1/3 of the direct lending universe. Kelly mentioned 300 billion. So about a third of that, 100 billion or so, is in software,
our
which
index.
in our index, yeah.
Yeah. Yeah.
So you need a lot of defaults to really drive that rate higher, and large defaults. The small ones are not going to move the needle enough.
And I think you're right. It is the big fear of the unknown, and senior lenders hate uncertainty. And you
Yeah.
combine that with big headline names that are in trouble, like, Pluralsight a couple of years ago, and now Medallia. Those are both very large deals, billion plus deals. So that grabs headlines, and they're big defaults, but that's not the majority of the market. And also, I would say, manager portfolios have grown so much. Medallia is a multi-billion-dollar deal, and BCred holds a lot of it. Their AUM now is something like $80 billion. So even with Medallia, and let's say, a few other big credits that turn sour, the universe is big enough where they can take a lot of hits and still not dent investor returns too much.
And how different is that from, say, 5 or 6 years ago in terms of that point? Is that showing more resilience in the overall market, that it's just expanded that much? in 5 or 6 years ago, if this situation played out, would it have been a bigger, issue for the market overall?
No, but I think perception wise, it would have been the same. 5 or 6 years ago, you're looking at 2020, 2019. Back then, the biggest private credit deal done was about $1 billion. Now, I think the record is around 6.5 billion. So there's greater capacity today, but like in relative terms, I think it would have been the same 5 or 6 years ago, relative to the outstanding amounts in private credit. So, but you would still have the same perception risk or perception concern.
Yeah. When it comes to, how investors should think about recovery values in asset light sectors like software, maybe Eric, how
Yeah.
should they think about that?
Yeah, so that's actually my bigger concern is implied
Okay.
recoveries versus the actual default rate. So everyone kind of touches on the headline stories about how bad the default rate could be, but the recoveries, again, we've seen roughly about 50 cents on the dollar has been the recovery for the past couple of years, and the forecast is for a little bit lower for 2026. Even on an unweighted basis, it's even lower. We're talking about 36 cents on the dollar. So that really is where my concern is that the companies that are going to default, they're going to perform pretty poorly. Now, I
Yeah.
guess the good news about all this is when you look at the loss given default rate, which combines default rate and the implied recovery rate, that's actually pretty low. We're still talking about 1.25%, which is quite benign.
And how does that compare to syndicated loans? What's that rate against?
Yes, the BSL is more like 2.5% at the end of the
Yeah,
day.
so even in BSL, it's also modest.
If we look at, kind of go back to transparency and data, is there one statistic, from your research that you think the market should be paying more attention to?
In terms of transparency,
Or just overall data points? Like, is there something in the data that you think is not getting enough attention?
I think loss given default rate is a really underrated measure that we probably should promote more, because at the end of the day, that's kind of the number to go by, right? Like, despite what the default rate is and despite what the recoveries are, what does this actually mean overall? And it's quite low. Eric, do you want to throw your 2 cents in there on that one?
Yeah, that'd be my answer too. I mean, again, it's the implied recovery is my worry, but I think at the end of the day, the loss given default rate, that's the final answer, right? So if recoveries, default rate was 10%, but the recoveries were 100%, nobody would care. Obviously, that's not the case, but yeah.
What about maturity walls, refinancing risk, kind of playing a bit more into this part of the conversation. What is your data set telling about, say if we look over the next couple of years?
Yeah, it's not much of a concern, honestly. If you're looking from on a volume standpoint, only 10% is coming due by the end of 2027. And almost 40% is now at either 2031 and beyond. So a lot of the deals done over the last couple of years has pushed the wall out. And we always hear about the maturity wall, whether you're talking about direct lending, broadly syndicated loans, how every year in 3 years is going to be trouble. And yes, these universes are so big, so it's easy to make this a headline story. But there's 1 billion or whatever coming due in 3 or 4 years. But the market is pretty resourceful and able to handle this.
I would add too that, given that there's, interest rates might actually reverse course and start going up later this year, you might see a bump of refinancing over the summer into the third quarter, fourth quarter.
If we look at, a bit forward looking, is there any, underappreciated strength in the overall direct lending market today?
2 things. One, it's a huge universe and
Yes.
made up of mostly small credits. And it can really take a beating before investors are going to feel that in their returns. The second thing is for senior secured risk, the yields are great. They're 9% today. Single B, like a comparable single B syndicated loan, that's 7%. Also a good return for senior secured risk. So I think for the type of asset that you're investing in, compared to equities or treasuries or somewhere else, you're getting 9% for your money on senior secured risk. And I think that is definitely underappreciated and gets missed in a lot of the headlines.
Is there something more the market should be doing to maybe get out of this? Like, because obviously, from the perception of where we are now is obviously a negative perception if you're reading Bloomberg or, one of the big outlets. But the data is telling you a different story. And it feels like there's kind of this like strange dynamic happening. Can the market be doing more to help get out of that dynamic? And point two, the 9% you just talked about, or the conversation we had around, the defaults and recovery rates, and because there's a lot of underlying data that's showing strength in the market when the stories on the front page tend to be a bit more negative.
Mm-hmm. I think managers really started to address this in the first quarter after these, they got pounded by these redemption stories. You saw Blackstone hire a broadcasting veteran to come on board. And obviously that was to, put out content about, countering the negative headlines out there. Blue Owl did a series of interviews on television talking about redemptions and trying to educate the audience on what this means and how this is actually functioning normally. So I think more of that needs to happen. Eric Getty at Ares, he's very good about posting and doing interviews. I think, managers just need to get in front of the media more and talk about these issues more.
I'd also add probably more of a bottom-up approach than a top-down approach kind of helps in this market. It's really going through the names. That's kind of how we do our forecast here, is going through the 3,000 names and trying to figure out, will a company default and when? Now, granted, it's more art than science, but if you start doing that kind of exercise, you're able to see how these ideas of double-digit default rates and stuff like that is just not feasible.
And ultimately, is this an asset class, and I'm talking more direct lending versus the broader private credit universe, that should be, pitched to retail investors?
That's an interesting question. So I think here's one thing that doesn't get discussed enough, which is, retail investors can already buy exposure to private credit if they want to, and they can do it on publicly traded exchanges and by publicly traded BDCs. They can go by Ares Capital Corp. It's just one that comes off the top of my head. There's about 40 or 50 of those. So you don't actually need to go into a private credit fund that's not traded to invest in this asset class. And you can trade in and out of that regularly, daily. You don't have to wait for a quarterly redemption period in order to exit. So where's the discussion of that? Like, that already exists. Yeah. So retail investors have that exposure already. I will say that I think managers, having gone through this, pounding by the media and redemptions, really need to ask themselves, is this worth the trouble? Is this worth the perceived reputational risk? Is it worth inviting more regulatory scrutiny onto the asset class? I'm sure they will all say yes, because we're talking about big fee, we're talking about fees here, fee revenue. But I do think I did hear recently from one manager, the danger of going too hard into retail and 401ks is then you are going to invite more regulatory review, because that's going to be perceived as, playing with mom and pop money, retirement accounts, and not, strictly institutional capital. And then you run the risk of regulators coming in and trying to regulate you like they would a bank. There's a reason there are different regulations for institutional money and retail money. And I think the more retail money that private credit managers go after, they're going to be inviting more regulatory scrutiny. And, that puts sort of the whole game at risk.
So I always like to end episodes a bit lighter with some fun questions. First one is favorite sports team and/or hobby. Kelly, you first.
Favorite sports team? I just don't care. I would say my favorite hobby.
Go with hobby.
I know Eric's disgusted. I should say the Knicks, right?
Me too.
I should say the Knicks. My favorite hobby is gardening.
Okay, what about you, Eric?
So I'm an avid fantasy sports fan, and thankfully for that covers my teams I root for, which are the Mets and the Jets. So I have a lot of suffering, but thankfully I'm a Knick fan also. So I've gotten my first win in about 40 years. So it's all good.
One surprising thing about yourself. This time Eric, you lead.
Well, I'm a kind of a girl dad. I got two daughters, so I can get sucked into reality shows or their teenage drama shows very easily.
Or Taylor Swift concerts.
That too, yes.
No. What about you, Kelly? Surprising thing about yourself?
I didn't have time thinking about this, but one thing I will say is I did meet Brad Pitt once at a movie conference in Las Vegas, and I was about 20 at the time. So I thought that was the highlight of my life at that point.
One book you'd recommend reading. Kelly, you first.
I really like World War II history books, and I also like reading about North Korea. And one book I would really recommend is called Nothing to Envy. And it's a remarkable story about people trying to get out of North Korea. And even if you're not interested in North Korea or politics or anything, like the stories in there are just fascinating.
Eric, what about you? A book
I'm also a history buff. So 1929 is the book I'm reading right now. And I'm also reading the Accidental President, the Harry Truman one as well, kind of at the same time, which being 15-year difference is kind of fun to go back and forth. But yeah, those are my two right now.
Most exciting part of your job. Eric first.
Exciting is probably not the right word, but I do love going through the BDCs on a quarterly basis, trying to find, the new names to add to our default radar. That kind of gives me a sad happiness in terms of finding those.
Kelly, what about you? Most exciting part of your job?
I think what I enjoy most is I like talking to people in the market, because I learn something new all the time, and things are always changing. And right when you think, this is happening, then something else happens and introduces an entirely new dynamic. So it's always changing. And I find that it's interesting. And I like talking to really smart people in the market that share that with me.
And then final question, one prediction for the next 12 months. Kelly first.
I'm going to say interest rates will go up, not down. And I really hope I'm wrong about that.
And Eric, final word to you.
Nice. Well, I've got my forecast on defaults, which is 2.5%. So that's my prediction for the end of 26. But I'll go and say that I don't think we actually will see double-digit default rates again in our lifetime if the universes are this big and stay this big.
I think that's a good place to end it with a bold prediction. Kelly and Eric, thank you very much. Really appreciate the time, and continued success to you and the team.
Thanks, Todd.
Todd. Appreciate it.
Yep, thank you. Thank you for listening to the Credit Clubhouse podcast. Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.